I would say that we've made a lot of progress on inflation. The last couple months have been frustrating, just given how stubborn that those reports have been. Services have been super sticky. Shelter's been tough. And I think we knew that was going to be a tough one to break, this final yard or this final inch, however you want to think about inflation, the fight with inflation. This last yard, if you want to go back to football terms, that the goal line is going to be the toughest one to crack, right? And we're seeing that right now. Coming into 2024, core PC, and PC is the preferred inflation gauge for the Fed. Core PC actually, on an annualized basis, got back down to the 2% target that they were looking for.
Hi, and welcome to Wealthion. I'm James Conner. And before we get on with the interview, I want to remind you that Wealthion has a virtual conference coming up on June the 1st. We have some amazing speakers, including Raoul Paul, Lynn Eldon, and Rick Rule, and many more, all of which will help you prepare for your financial future. Once again, that's on June the 1st. You can find more information on wealthion.com. And now, on with our interview. My guest today is Bret Kenwell. Bret is an investment and options analyst at trading and investment platform eToro. Bret, thank you very much for joining us today. How are things in the great state of Michigan?
Things are going great, James. Thanks for having me.
So you and I are not too far from one another. I'm about a 4-hour drive from Ann Arbor. Are you a Michigan fan?
Yeah, big Michigan fan. I grew up about 20 to 30 minutes outside of Ann Arbor, and I live a few hours north of there now, but yeah, still a big fan.
So I've been meaning to go to a Michigan game for a long time now, and I have yet to do it. I hope it's going to happen this coming fall. I want to go in September, October when the weather's still nice and the tickets aren't too expensive. Maybe you can help me out with some tickets.
Yeah, maybe we can have a Wealthion eToro meetup.
And yeah, that would be a great idea. And what about the Detroit Lions? They had an amazing year last year. Are you a big Lions fan?
Yeah, big Lions fan, big football fan in general. But yeah, for the first time in a long time, it finally felt like it was Detroit's year for football. So it was between them and U of M, it was a pretty fun fall.
Yeah, I'm looking forward to this upcoming football season. So let's get on and discuss the markets. And maybe even before we discuss the markets, eToro is a social investment company. What do you mean when you say social investment?
Yeah, so eToro has a social feed embedded right in the trading platform. So investors can, if they choose to share what they're trading, buying and selling, other investors can see what they're doing, and it's not meant so much to be necessarily something you just blindly copy, but maybe gives you a nudge in a direction that other people are looking, or gives you some inspiration when you're looking. Maybe you sold something recently, you have some profits you'd like to put back to work, and you take a look at the feed and see where other people are putting their money to work. And you can follow certain investors if you have similar styles, or you tend to invest in the same assets. You can follow other investors so you can keep pace with what they're doing, and maybe they uncover a couple of stones for you that you maybe wouldn't have noticed before.
And so there's a lot happening in the world right now, and one of the noticeable trends that's happened here in recent days was the comeback of Roaring Kitty. I'm just curious, are a lot of your investors or traders investing in GameStop or AMC?
Yeah, we definitely saw an uptick in volume, especially on the options front around that event earlier in the week for sure. We definitely did some pretty heavy volume in those areas, but it was interesting to see the buys and then the sells sort of flow in pretty quickly after. It showed that I think our investors were more just focused on sort of a short-term catalyst versus thinking that this was some kind of long-term big fundamental change when really that wasn't the case. So and seeing it on the option side was interesting too, because it showed that versus doing it in common stock, that our investors were focused on the risk aspect, in which, yes, the premiums for those options were inflated because the volatility was so high, but at the same time, they know that their risk is limited when they do it through options. So it was a smarter way to play it if they did want to be involved. And of course, plenty of investors didn't want to be involved, and it's not hard to see why. But yeah, some great moves there if traders are active enough and can capitalize on that sort of thing.
And given that the market's making new highs every day or every other day, what other noticeable trends are you seeing from your investor base?
You know, I think the most surprising thing to me was to see. So every quarter we do what we call retail investor beat survey. We call it RIB for short. But to see just how much investors were broadening out their investments from just the typical tech is usually such a heavy investment, and especially in mega cap tech, your Apples, your Nvidias, Amazons, those sort of names. And actually, when we did our RIB survey, we found that financial services, so banks, essentially were the most popular asset among buyers, which was that really surprised me. Banks tend to be fairly boring and much less exciting than your Amazons and your Nvidias and whatnot. But yeah, we've seen a lot of action around AI. We've seen a lot of action in chips and banks, as I mentioned. But just in general, a broadening out in their investments, which seems to kind of fit the narrative we're seeing in the market. It's no longer just tech driving things. It's a number of sectors really powering the markets right now.
So your firm has been bullish for quite some time now, and I want to get your thoughts on the economy and the market going forward and what your thoughts are. So why don't we just start with the U.S. economy? We recently saw a weak Q1 GDP number. It came in at 1.6% versus consensus of 2.4. Prior to that number, it has been very strong, and we're still seeing some very strong CPI and PPI numbers. We've also had 25 consecutive quarters of the unemployment number coming in below 4%. Like I said earlier, the stock market continues to make new highs every day or every other day. So things look pretty good. What's your take on the U.S. economy here?
You know, I think the economy continues to do pretty well. We had the Q4 print was incredibly strong. The Q3 print was incredibly strong. Q4 print was also strong. The Q1 print for GDP was below expectations. I will say it will be subject to multiple revisions. So we could always see that number come back up, but it's been kind of an interesting start to 2024. I know we're going to jump into some inflation report, some inflation talk here in a few minutes, but inflation came in pretty hot the first few months. GDP came in kind of soft, and now we're starting to see some other little signs of softness in the labor market and the consumer, whether that's through the monthly jobs report, weekly jobless claims, retail sales. So we're starting to see a little bit of softness, but overall, I think the economy continues to do pretty well, and it's hard to make too much out of a few weeks worth of data points. We really need to see a few months of data points to draw a larger conclusion. But overall, I think the economy continues to do pretty well, and that's reflected, I think, in the stock market as well.
So let's talk about inflation. The recent CPI number came in at 3.4%. That was in line with expectations. Still seems very strong to me. Core came in at 3.6%. Shelter was 5.5% year over year. I think that's extremely high. And even though these numbers were in line with expectations, it still looks like it's running very hot. And the Fed and the government will lead us to believe, oh no, we got inflation under control. Don't worry about anything. What are your thoughts on inflation here?
I would say that we've made a lot of progress on inflation. The last couple months have been frustrating, just given how stubborn that those reports have been. Services have been super sticky. Shelter's been tough. And I think we knew that was going to be a tough one to break this final yard or this final inch, however you want to think about inflation, the fight with inflation. This last yard, if you want to go back to football terms, that the goal line is going to be the toughest one to crack, right? And we're seeing that right now. Coming into 2024, core PC, and PC is the preferred inflation gauge for the Fed. Core PC actually, on an annualized basis, got back down to the 2% target that they were looking for. That was coming into the year, and obviously since then we've seen inflation pick back up. So I think right now everyone's maybe getting a little doubtful, but everyone's still waiting to see if this is more of is this a 3 to 4 month bump, a short-term bump in the road to lower inflation, or has the Fed done what they can do with where they have rates now in terms of their fight with inflation, and now we've kind of plateaued? This latest inflation report was a positive development. It was relatively tame compared to the last few reports. As you mentioned, core CPI came in at 3.6, but it was also the lowest reading in 3 years. So there are some silver linings with inflation, but and I know the reaction to that has been largely positive on the assumption that now the Fed has the leeway to lower interest rates later this year. But I am optimistic. I'm bullish in general, and I do view I do view the progress in inflation as positive. But I would certainly argue the other side and say it's positive, but we're not out of the woods yet.
Yeah, I would agree with that 100%. It's amazing, though, that we look at 3.6% inflation and think, everything's great. Now, I know you're based in Michigan. I'm curious, what are you paying for a gallon of gas?
Gas, it seems to fluctuate quite a bit, more than I would have thought it would fluctuate. I think recently it was about $3 a gallon, though.
$3 a gallon.
Yeah,
That's pretty damn cheap. Oh my God. I'm paying in Toronto, we're paying about $6 a gallon. I kid you not.
that that sounds about like California prices.
Yeah. Is that what it goes for in California?
I think it's like 5.75 at the moment, but yeah, it's pretty high compared to other parts of the country.
Yeah. Maybe I'm going to have to start driving to Michigan and get my gas. So, okay. So that's a good overview of what's happening with inflation. Now let's talk about interest rates. And interest rates have been on hold since July of 2023. Hard to believe that's coming up to a year, but we still have the highest Fed funds rate in 23 years. And the move that we've seen in the markets, it's all predicated on cuts in interest rates. And we started the year thinking we're going to get 6 interest rate cuts. Then that went down to 3, then 2. Some are saying we're only going to see 1 cut this year. And some analysts are predicting we're going to see no cuts this year. What's your take?
Yeah, I think it's really interesting, especially if you look at it from a market psychology standpoint with investors and if you want to call it the crowd. Go back, maybe 8 months ago, 6 to 8 months ago, and the Fed came out and said, "Hey, we're going to we're pausing here on rates, and we think it'd be appropriate in the next year to lower rates." And investors took that opportunity to essentially front run the idea that rate cuts were coming. And then, like you mentioned, they priced in 6 cuts for 2024. And it's proving to be like a giant pendulum swinging back and forth. We went from 6 cuts to we got a few hot inflation reports. Those expectations dialed all the way down to, and while the bond market never priced it in, the rhetoric became, hey, is it time for another rate hike? So, and now we, of course, mellowed out a bit and we're back in the 2-cut camp, I believe is the new consensus. So I don't know. I think 2 cuts, 1 to 2 seems appropriate. Unfortunately, it is kind of a data dependent situation, as the Fed always likes to say. But if we keep going, I think the expectation is that services inflation will soften in the back half of the year, especially as it relates to core. So that if we get that, I do think 2 cuts is appropriate, and it will probably get the chatter going for 3 cuts, only because the Fed's dot plot both in December and in March was for 3 cuts. So I think if we get to a consensus of 2 cuts, it'd be reasonable for at least the chatter to start talking about 3 cuts.
So let's talk about the U.S. consumer now and the health of the consumer. I recently had a discussion with Kyla Scanlon. She's a young economist, and she coined a term called vibesession. Okay. And by that, what she means is even though the economy is doing very good, people aren't feeling that good. And I get that. When I read a lot of the commentary, when I watch a lot of YouTube, that's the sense I get, right? The U.S. consumer is not feeling good. And we recently saw numbers out of Starbucks. Their global same-store sales all across the U.S. were down significantly. China, they were down significantly. And those 2 markets represent 60% of their revenues. But what's your feeling about the U.S. consumer here? How do you think they feel?
I think the consumer feels a little bit tired. And depending on where they fall in the income bracket, they could be pretty resilient or they could be very, very tired. Inflation has put the pinch on. I know we usually focus on inflation from the perspective of the Fed and what they're going to do in interest rates. But from a consumer standpoint, inflation really pinches them. By the time they pay their rent, their healthcare, their childcare, groceries, gas bills, they might not have anything left over at the end of the month, and they might even be in negative territory. Um, you know, that's a really draining feeling on somebody emotionally and mentally, and it does drive this sense of being kind of fed up with it. And I think when you look at you mentioned Starbucks and McDonald's and a few other companies, some of those I think can be company specific issues, but largely I think we are seeing that, especially the lower end of the consumer feeling tapped out. And it's just one more reason I think why um, we need to see more progress on inflation. If not for the interest rates, that's kind of, I don't want to say secondary, but speaking largely for just the population in general, I think we need to see progress on inflation so that the consumer ends up being okay. When we look at some of the recent data, if we zoom out for the year to date, say, the consumer's been pretty resilient. You mentioned the labor market at the top of the show has been very strong. Unemployment rate has stayed below 4%. But when you look at some of the recent data, whether that's, the recent retail sales print was below expectations, the prior month was revised lower. Consumer sentiment, the latest reading from consumer sentiment was weak. Jobs report missed expectations. So we're starting to sort of see that tiredness from the consumer manifest itself in the actual hard data of the economy. And while some softness is okay, we do kind of need some of that to soften, but it's a delicate balance. We need that softness for inflation to come down, but at the same time, we don't want it to get so weak that it starts to cause economic strain. And that's, I think, sort of the fear in the back of investors' mind, and it should be the fear in the back of investors' mind.
Yes, and I think the commentary out of both Starbucks and McDonald's was that the consumer is not spending like they used to. And so I think that's really interesting to see. We've also seen weak numbers coming out of LVHM and also the parent company of Gucci. So even at the high end, the consumer globally is not spending the money that they were just a year ago.
Inflation has a way of chiseling you down, both in your wallet and mentally. At a certain point, you get fed up by it when you go to the pump your gas, or you go into the grocery store and you maybe put some stuff back on the shelf because the prices are just too high. So, it's definitely had a negative impact. But the hope is that we can come out on the other side of this without sacrificing too much of the labor market and too much of the economy.
Yeah, yeah. You want to talk about high prices? Come to Canada. Our payroll taxes are 50%. I am not lying to you. And then, like I told you before, we're paying $6 a gallon for gas. I don't even want to tell you what I'm spending a week on groceries now. It's just insane. I'm going to have to get a
Yeah.
part-time job as a Uber driver.
Yeah. It's been a tough stretch, but it's hard to believe where inflation was. Go back a couple of years to see some of those 8% and 9% prints. Those are very startling. So we've had progress, but I think people are getting their patience is starting to run out on how long we're going to have to wait to get back to a normal level of inflation.
So let's put all of these elements together. Okay, we talked about the economy, the inflation, interest rate expectations, and let's talk about the stock market. Okay, the S&P, the Nasdaq, the Dow. The Dow just hit 40,000. All-time record. S&P and the Nasdaq aren't too far behind, but it's like the market's going up every day and making new records. And once again, this is all predicated on lower interest rates. What's your feeling on the U.S. stock market here, and do they continue to go higher as we go into year end?
I would make two main points, and the first one being that the stock market is not the economy. And the second being that interest rates matter, but they're not the only thing that matters. And I think it's case in point by the fact that we came into the year very strong. The S&P came into the 2024 with a lot of momentum, but we also came in with the expectation of 6 rate cuts. And in that first quarter, we saw those expectations drop really considerably as inflation kept coming in hot. But the S&P continued to chug higher and higher and higher, essentially into early, into the end of the quarter. And when we came into April, we had this pullback. It was a 5 to 6% pullback, and I think that really helped reset sentiment. I think a lot of people were getting a little too comfortable or used to just I would say the easy gains, but the easy money. Like you said, we were in such a strong uptrend, and the S&P rallied for 5 straight months. It was up almost 30% from the October low. I think it even put in back-to-back quarterly gains of 10%, which is a really astounding amount of strength in such a short span. And so a reset made sense. It made sense to get a 5 to 6% pullback. Even a 10% correction, I think, wouldn't have been an unhealthy development. So I think what we have here is a strong market, and we see that strength even outside of the U.S. We see it in pockets of Europe. We see it in Japan. And so global equities as a whole have been doing really well, and I do expect that to continue in the second half of the year. And the reason why is, the market tends to be forward looking. So, investors might be, chomping at the bit to get, the latest inflation report or, the PCE report in a couple of weeks. But in reality, the market is a discounting mechanism, and it looks ahead, 6 months, 9 months, 12 months. And when we look out, we see earnings in the U.S. or specifically with the S&P are expected to not only hold up, but actually accelerate over the next 5 quarters or so. Even Q2 and Q3 are expected to go to 8 to 9% growth, and Q4 and the next several quarters beyond are expected to accelerate to a double-digit growth. So I think the market sees the earnings growth. It sees lower interest rates on the horizon, whether that's 2 cuts in 2024 or less, or maybe one more, whatever, somewhere around 2. And it sees cuts, in 2025 as well. So there are positives on the horizon. It can be easy to get hung up in the day-to-day, but the bigger picture still remains pretty constructive, in my opinion.
So just to summarize, you are bullish on the U.S. economy. You're bullish on the U.S. stock market.
Yeah, I'm cautiously bullish on both fronts. In April, our tagline became we're optimistic but realistic. So realistic in the sense we've gone very far, very fast, and that maybe some sideways price action or lower price action would be reasonable, but optimistic in the back half of the year and 12 months out.
You're sounding like a politician now.
I try not to.
Okay, so one of the things that's interesting about eToro is that you cover both gold and Bitcoin. Why don't you give us your views on both of those assets?
Well, gold has been doing really well, and if you take a more zoomed out look on Bitcoin, it also has done really well. It's kind of lost a little bit of its luster. Some of its shine might have gone to gold over the last few months, but Bitcoin in general continues to do well. I mean, when we zoom out and look at the year to date and the 12-month performance, Bitcoin's done really, really well. But it needs a new catalyst, and I think at the moment the idea of lower interest rates sometime this year is acting as that catalyst. We saw Bitcoin rally, I believe, it was over 7% yesterday alone, far outpacing the S&P and the Nasdaq. So I think it still looks good to me. It seems like it's just in a sort of a holding pattern. Kind of looking for that either enough rest to resume the uptrend or waiting for that next catalyst to go higher.
And so right now it's just consolidating. What would be the catalyst to take it higher?
Well, Bitcoin just had its halving event, which has every 4 years, and that is typically a pretty, or at least historically, has been a very positive catalyst. And I think we might have seen a little bit of, investors are smart, so I think we've seen a little bit of a front run on that. Bitcoin rallied really hard into the January ETF decision by the SEC, and then we saw a period where it cooled off. And then it broke back out again, and it ran to new highs into the halving event, and now it's cooled back off again. So to me, the trend still looks okay, especially when, like I said, when we zoom out to a larger time horizon, it still looks pretty constructive. But I don't know when that next move comes higher, but consolidation is healthy. It does help provide the energy for the next move.
And I'm sorry, what are your views on gold?
We remain constructive on gold as well. It has moved it quite a bit. I believe it's still outpacing the S&P on the year. I would have to check the numbers one more time, but we remain constructive on it. We don't do price targets, but we do remain positive on it.
Well, that was a great discussion, Bret, and I want to thank you very much for spending time with us today. If someone would like to learn more about you and your various services, where can they go?
Yeah, I'm on LinkedIn and both, or Twitter or X, whichever you prefer to call it these days, and it's just my name, Bret Kenwell, at either site.
And you publish on a regular basis?
I do publish on a regular basis. Yeah, it will usually be my Twitter feed on the most consistently.
Once again, thank you.
Thanks so much for having me, James. I had a great time.
Well, I hope you enjoyed that discussion with Bret Kenwell, and it provided you with some insights on what to expect in the coming months. And to provide you with even more insights, we've organized a virtual conference coming up on June the 1st. We have some amazing speakers, including Ralph Paul, Lynn Alden, and Rick Rule, and many more, all of which will help you navigate these uncertain times. Once again, that's June the 1st, and you can find more information on our website, wealthion.com. I want to thank you very much for spending time with us today, and I look forward to seeing you again soon.